Thanks everybody for coming. So I'll introduce Alex Wambold. Alex has been a realtor for 8 years, came to Canada in 2005, moved to Vernon in 2010, and he's been a realtor at RE/MAX since 2012. He bought his first investment property at only 17 years old, and now him and his 4 brothers own a company that owns 38 doors around the North Okanagan. He truly is his own best customer, that's for sure, and he's helped many clients start their investing careers as well. So Alex, maybe give us an idea of how you got into your first investment property.
So the first investment property, basically we were somewhat pushed into. We were renting a 2-bedroom apartment with my brother, and our father basically met us one day and he said, here's a down payment, there's a good opportunity out there on a townhouse, go ahead and buy it. Technically I wasn't even eligible at 17 years old. I wasn't even able to be on a mortgage. So my brother was 18, he turned 19 I think a few days prior to closing on the deal, and that's how we were pushed into it. But it was the greatest opportunity or decision ever, because we didn't know any better, and we had somebody that was a little smarter than us, that had a little bit more experience, that knew how to guide us. And I think that is a very important part in the whole process, to have somebody guide you as you become a learner, an investor, is to have a mentor that can teach you and guide you, and sometimes even give you a little bit of money to help you out, because we didn't have it.
That's the best part, having the money, for sure. That's a good story. I love that. So Alex, explain to us about cap rate.
So cap rate is basically a term that is being used to figure out what kind of percentage you make in terms of an income. And the cap rate can be a great thing, but it can sometimes get in your own way. Because what if a property is completely vacant and it doesn't even have any rental income? So cap rate, to bring a very, very simple example. So if we have a condo that costs $200,000, the rental income would be $1,400, but you have expenses, you have strata fees, you have a little bit of money for maintenance, insurance, etc. Let's say you have $1,000 left over clean at the end of the month, not including your mortgage. The mortgage is never part of that cap rate calculation. But let's say you've got $1,000 left at the end of the month. What you do is you take that $1,000, you multiply it by 12, which is $12,000 a year. And now you take the $12,000 and divide it by $200,000, which is the purchase price for the condo, which generates a 6% cap rate. And a 6% cap rate is considered average. We usually look at cap rates to be acceptable between 5 and 7%. However, as I mentioned earlier, cap rates are a good way to look at the initial investment, but do not ever get caught up on a cap rate. Because even if the cap rate is low and you got a building with 24 units, well, it'll take you a year to bring it up from 4 to 5.5, because you'll give a rent increase to every tenant out there. So it's a good indicator, it's a good formula, but it's not truly what we always look at.
Right, there's more things that come into play here than just the cap rate.
Exactly, especially if the building is run down. Who cares about a cap rate? You're going to renovate it anyways and put in a new tenant in there.
Right.
Then you'll get the cap rate you need.
Right.
However, it is important for banks. So there's a little bit of an alignment you have to make happen.
Right. So can you give us a sample, of what would be a good, good investment property with a good cap rate, or with do you have a sample for us?
Yeah. So what I've prepared is the latest flip that we've done to bring into perspective. So this is the property we've just purchased December 2019. And here are before and after pictures. I'm just going to share my screen with you guys so you can see that. And you can Just let me know if you see it.
Almost, it says you've yep, there we go.
Okay, so this is the sample of just the latest property we've done a flip on, and we've sold it successfully. So we've basically, this property, just to give a little bit of a background history, divorce sale, been on the market overpriced. They've been reducing their price. Eventually they've reduced, I think, 40,000 one morning. I saw it in the morning, booked a showing with my brother at 1 p.m. and wrote the offer an hour or two later. Unconditional, nothing to it. They lowered it down to 240. We wrote 220, closed it at 230, unconditionally was sold. So that is 6687 Long Acre Drive. We purchased it for $230,000. So you can see the before pictures and after pictures. So we've done a full renovation to it. And you can see, like, just as an example, even the photos, like how important it is to shoot it from a right angle. So the right hand side is our photographer, for example, or the whole online exposure, etc., and how important it is to have a professional photographer. But over here you kind of see the before and after pictures. Obviously we see something very run down and now very pleasant. Now the numbers are the following. I'll show you guys the numbers. So the numbers are the following. We purchased it for $230,000. The total renovation down here was $79,900. So call it $80,000 to do the work. The labor cost was the most expensive part about it, was 47. Call it 50, just for number's sake. And then the material was 32,000. And one thing I've purposely, wanted to point out is the kitchen part. A lot of times people think kitchens are super expensive, but it shows that we paid $11,300 for 2 kitchens. And I think we bought it at Home Depot. Kitchens are not that expensive anymore. So in other words, cost us $80,000. We put it on the market for $375,000. First or second buyer that looked at it put in an offer, came in lower. We countered back full price because we priced it right, got it accepted at full price, and sold it at full price. So the profit we made was closer to 15% on the investment. It took us about 4 months from the day we purchased it to the day we sold it. So our money was tied up for 4 months. In other words, we made about $50,000 on it, which is considered very good. Now, this was one of the better investments, I would say, but this is just a very strong example on a flip. Now, if I bring another example on a property that we didn't do anything to, or almost nothing to, I don't have any numbers here, but I'll unshare the screen and I will talk about that. The one that we've purchased. So in 2016, we've purchased a 4-plex. We actually purchased 2 4-plexes right across from each other. Now, in 2016, we purchased a 4-plex on 24th Avenue, which is considered one of the not so greatest streets in town. It's quite famous, actually. And you would think that a bad area doesn't really have much growing potential. However, the reality is that we had to start out somewhere. And we started out there. We purchased the 4-plex. I'm going to talk about the one specifically. For $600,000, we were in a multiple offer situation. We offered them full price for the property. And all we've done is basically we've just increased the rental income. And then when somebody moved out, we just got market value for it. We sold the building last year for $735,000. So $135,000 higher, considering the commission we had to pay on it and the other selling expenses. We made about $120,000 on it, just from buying and selling it and not really doing a whole lot to it. However, in those 3 years, the tenants have paid off about $100,000 on our mortgage, because there's 4 tenants in there. In addition to that, we've also had about $100,000 left out of all the rental income to use up for other investments. So really, the reality is purchasing a 4-plex on 24 Ave 3 years later, we've got $300,000 more in our pocket. I think that's a pretty good deal.
It's a very good deal.
I think it's a great deal. Now, the market did go up. We have to keep that in mind. However, even if the market would have not gone up, we would have still had about $200,000 more in our pocket, which makes sense considering it was only 3 years ago.
And now you're talking about, the two examples you've given are properties that you've purchased and then sold. But long-term holds are also excellent investments over time. I mean, if the market goes down, then you just wait it out.
Definitely. In fact, we were planning on holding on to them for longer. That was the idea. However, when we were growing our assets and our investments, we realized, well, in order to buy larger buildings, we have to let go something. So eventually, we had to let go of the smaller buildings to buy larger buildings. So we've purchased a 23-unit condo building last year, which is considered something we're going to be holding on for longer. And that's the kind of type that ultimately we want to hold on longer, because that's not the product you quickly buy and sell. However, the other smaller investments, they are great to hold on for a long time, or if you're really doing well with the whole investment game, then it probably makes sense to let go. Let go something that is basically allowing you to grow. That's the idea. And anything that is really like a snowball machine, like the 23-unit apartment building, that's the stuff you keep. And that's why they come available so rarely.
Exactly. Everybody keeps them.
Yeah.
Yeah. So Alex, let's talk about, you kind of alluded to it a moment ago, saying that, when the prices go up, or when there's more equity in the place, that you can, one of the ways of doing some creative financing is to take some funds out of the equity in the property that you have and buy something else. So let's talk about those creative financing ideas.
For sure. So the word itself, creative financing, just even explains the fact that it's a very wide, broad window, and there's a lot of ways of looking at creative financing. Now, the number one thing to consider is to use your line of credit on your house to buy other properties, because you can write it off, and it's very easy to do, not a big hassle. You just get an appraiser in, refinance, take that money, purchase another property. It's just the best way of doing creative financing. Now, we've practiced something else before, which really worked out in our favor, where we didn't have enough down payment. But we found a building that was making decent money. It was ran down. It was a 12-plex, and we've purchased it for $900,000. We only had $100,000 to work with. That's all we had for a down payment, and even that we took out of my brother's line of credit. So really, we didn't have any money. We were 100% financed. So if you purchase a $900,000 building, you generally need 25% down, which is $225,000. So plus property transfer tax, lawyers' fees, etc. So let's say we were short $150,000, which we were. We were $150,000 short to make this deal happen, but we wanted the building. And what we've done is we went to the seller and said, Mr. Seller, why don't you give us a vendor take-back mortgage for $150,000? We put down $100,000. Now the bank gets their 25% down payment, and we will borrow the other, whatever it was, $650,000, $700,000, whatever we borrowed from the bank to make the deal happen. The reality is we only had $100,000. Well, it all worked out with the bank. The numbers worked out. We purchased the building in 2017, April. We have increased the tenant quality. We kicked out a bunch of bad tenants. We've renovated the building, and we have sold the building. We've completed on it last Monday. this Monday. Sorry, the one that just passed for $1.4 million. So from coming in with literally nothing to 3 years later with selling for $500,000 more. Of course, we put a lot of money into the renovation. We've had a lot of dealings with the tenants. We increased the quality of the tenant. We did a big renovation. We had to refinance all of that. But the opportunities that are out there are so great. And the reality is that building has been on the market for a very long time and nobody wanted to buy it. And you know what happens when nobody buys it? The buyers out there saying the same thing. Why isn't anybody buying it? There must be something wrong with it. They just think that way. And suddenly it becomes stale. And we go on there and we do all of our due diligence. And we're like, what's wrong with it? Why is nobody buying it? It makes sense. And we jump on it. And here you go, 3 years later, we've got $400,000 more in our pocket. We sold it for $500,000, but remember we put $100,000 into the renovations. So now we've got $400,000 more in our account. However, in the meantime, the tenants have probably paid off. I'm making a judgment here. Probably $150,000 to $200,000 in mortgage. Now again, in the meantime, we have refinanced that building and have taken out equity and purchased the 23-unit multifamily building. So you can see that there was so much creativity and so much opportunities we've taken out of a shack. And that is exactly what I'm always so excited about, is to promote that opportunity that people don't see. They see work, they see bad tenants. That's right. There was a lot of that. But there was so many more opportunities that came out of it. So that's my story on that one. I think it was a very good success story.
It's a great success story. You can't be afraid of work to get into something like this. Like, you've got to be willing to put in the work. And like you say, you were willing to, and no other buyers were at that particular time.
That's right.
Yeah.
That's right. And that's why the sellers were willing to do the creative financing. A lot of sellers won't do it, right?
Right. Good point. So Richard was asking, he says most of his money is tied up in RSPs. Is there any way to use RSPs to secure a down payment? Now, I think that's just for your principal residence, isn't it?
Yes. Yeah.
Yeah. Unfortunately not. And I don't believe that you can borrow against those RSPs either.
No.
Yeah. And no one's too excited about cashing them out and paying the tax on them, but that's probably, unfortunately, the only option with the RSPs. So Alex, how do you know, like, what's the process you go through? How do you decide what you're going to buy and when you're going to sell, and what would your tips be for buying and selling a great investment property?
So one thing that I always hear is a lot of people are saying, well, you realtors are buying all the good deals before they hit the market. And what I say in return is, no, we just know how to use our own tools that are available for our clients. So what I do, in order to find a good property, we set ourselves up on an auto email search, the search that we provide to our clients, the same tool we now take and send listings to ourselves. So we can stay on top of everything that is coming available. Now, the reality is that sometimes people say, well, call me if there's a good deal. And the reality is, hey, don't wait for my call. Don't wait for my call. Because if I call you and tell you there's a deal, you don't know that it is a deal because you haven't done any due diligence or you haven't been educated enough. So the first thing we do is we set ourselves up on an auto search for certain properties and we become very, very educated. The most important thing is to go out physically and look at these properties. Like just go out and look. And as you look, you become super educated and you work with the tools that the realtors provide, like the auto email search updates. And with that, you stay on top of it, because if a new listing comes on today at 1 p.m., I will get that email and you will get that email as soon as the internet browser will send it, within a few minutes. And you will be able to look at it and act. And the most important thing is, when there's a good deal out there, don't wait till Monday to look at it. You got to act. You have to look at it, and when you like it, you write on it. But you can't write on it if you're not educated enough. How do you know it's a good deal? Just because the realtor told you so? So that's why it's very important to look at them physically, set yourself up on an auto email update list, and get educated, because an educated buyer is what the sellers fear the most. An educated buyer is somebody that knows how to act and when to act and how to structure everything to purchase a property.
Makes sense. Yeah, makes sense. I just thought maybe we could go back to Richard's question just for a second before we go on to the whole selling the investment property part. But one thing you could do, Richard, is if you have equity in your principal residence, you could possibly take a down payment out of your principal residence and use it as your, take that money and use it as a down payment on an investment property.
Yes, and the good thing is, if he, let's say, takes out $50,000 of a line of credit on his personal residence and he purchases a property for $300,000, that $50,000, you can write off the interest you're paying on it 100%.
Right. Right. So Alex, what about selling? How do you know when's a good time to sell? You've sold a number of your rentals. Like, I was always of the impression when we owned a bunch of rental properties, it was more for the long term, but you've taken some profit and moved on. And how have you made that decision?
Well, so what I always say to clients and to myself, to my brothers, is that selling only makes sense if we have a plan B. Otherwise, selling doesn't make sense. There's way too many selling expenses. So we have a plan B that works out better than plan A, we're selling. Now, how do we sell? The greatest advice I can give is to start out right. You know, almost every property we have put on the market, we've had multiple offers, and we sold close to asking price or asking price. And the reason why that happened is because we were not fishing. We weren't fishing, you know, with a high price and a lower down, continue. We were there to make money. And, you know, the more time we lose, the more money we will lose. So we put it on, we calculated what we needed, we calculated market value, we put it on aggressively and got it sold. Literally, most of them sold within days. That's the reality. It doesn't matter what price range they were. So that's kind of our approach when it comes to selling. There's no point trying out high and thinking that buyers are not educated and kind of waiting, lowering, and then creating ultimately what the sellers have created on the 12plex. They started out high. They didn't represent proper value. The property was sitting on the market. It became stale. And then suddenly buyers start asking themselves the question, why didn't it sell? Yet if you price it right, buyers are all over it. And they pay asking or above asking. We've experienced that many times. Doesn't matter what market it is.
Yeah, the trick is to buy right, I think, as well, is it not?
Absolutely.
Yeah.
You can only buy right if you're educated.
Mm-hmm. Yeah, you make the money really when you're buying it versus, I mean, you set yourself up to make the money when you're buying it, and then you can sell it. Then you're set up so that you can sell in any market, really, if you need to, if you buy right.
Now, Laura, I will elaborate on that a little bit later as well, as to how to buy. Like in terms of how to structure a good buy and how to find a good opportunity.
Okay. All right. So give us an idea of some of the different types of investments, either that you've personally invested in or some of the opportunities that you see out there. What types of investments would you recommend?
So my father, he started purchasing houses and then he put in basement suites. And we thought that was great. And it is great. It's one way to kind of get into the market. It's a perfect start. But then we realized that, then you have 2, 3, 4 houses and you have 2, 3, 4 property taxes. You've got 2, 3, 4 insurances. You've got 2, 3, 4 roofs, etc. 2, 3, 4 furnaces, whatever. Suddenly your overhead becomes so large that your equity and your cap rate just kind of starts shrinking and shrinking. It's still great. It's the best way to get into. But we found that the multifamily game was probably the most profitable, because let's say you have, for example, 12 units and 1 or 2 tenants are moving out. Well, you still got 80% of the income. Let's say you have a house with a basement suite and the basement suite tenant moves out. Well, suddenly you have only 60% of the income, or in some cases less than that. If the upper tenant moves out, then you've only got 40% of the income, right? So we found buying properties with the most amount of rental suites has probably been the best investment, especially because the rental market is very strong. It's very easy to find tenants, etc. However, we've also been investing in commercial, and the commercial game is also very good because there's less maintenance with the overall tenants, etc. But the cap rate is smaller and the risk is a little higher. If you, for example, have a tenant moving out, then it takes much longer to find another tenant. But overall, the idea is to keep your eyes open for any kind of investment. You never know. Because there's just so many opportunities. We just purchased an acreage 2 days ago. And an acreage is not usually an investment property, but the acreage has a house on it and 5 shops. Well, now that opens up the investment opportunity because we can rent out those shops. So that's why I'm saying there's always an opportunity, no matter what it is, whether it's industrial, commercial, multifamily, residential, or even an apartment, just a simple apartment. It always depends on your budget and your experience and what you kind of like.
Right. And you can start, you've worked your way up to these multifamily places, and you started out with one little place and then worked it up from there.
Yeah, exactly. Yeah.
So how do you find, you said this before, so how do you find a good opportunity?
So we never know where the next opportunity will come from. And again, I'll go back to what people say. People say, well, you realtors, you're buying those properties before they hit the market. And the reality is that most of the properties we've purchased, or 90% of the properties we've purchased through the MLS, and we've paid asking or above asking price. And we've also paid lower. However, that's kind of generally what I always say. People say, call me with a deal. Call me when there's a deal. I don't call it a deal, I call it an opportunity. Because a full asking price can still be a great opportunity. A property that's been sitting on the MLS for sale for several years can still be an opportunity. It doesn't have to be that estate sale or the divorce sale or whatever happened. It could be anything and everywhere. So my recommendation is to always keep your eyes open and be flexible and look at things from an opportunity perspective. So, for example, that acreage we just purchased, well, it doesn't make sense. Why would you buy an acreage? It's just a waste. Well, it does make sense because it has an industrial component to itself with the shops. It has a house we can rent out. And now the property itself has development potential. And the property next door has development potential. Now we're looking at it, okay, well, we're going to be renting it out right now. We may not be making a whole lot of money, but we're going to carry and cover our mortgage. However, the opportunity with that property is much, much larger. And the reality is we looked at it initially and we didn't understand the opportunity until we started digging into it. And while we started digging into it and doing our due diligence, we understood and learned how great it is. And through that, you understand opportunities and you understand value. And that is the best recommendation I can make out there, is to get educated. Because as we're getting educated, we become very strong buyers. Why do we become strong? Because we can act quickly. We don't always need to do a home inspection. We don't always need to wait for an insurance approval. And lastly, if we got our ducks in a row on the financing end, we don't need to put in subject to financing. So the strongest tool we've been using in buying under market value, Lisa, and that's what you mentioned earlier about buying it for a good price. The strongest tool we had where we were constantly buying properties for under market value is when we came in unconditional. No conditions. Here's a check. We're buying your property, sign on the dotted line. Now the reality is that is very risky, because what if there is a problem with the house, or what if there's whatever? And this is exactly where an educated investor gets ahead of the market, because he's educated enough to take the risk upon himself to write an unconditional offer. And if I give some examples, we just purchased the property 3 weeks ago that the last offer was accepted at $380. We purchased it for $355, $25,000 lower. The property we purchased 2 days ago, the accepted offer was at $970, and we purchased it at $900 with much more included items. So we got it for $70,000 plus more or lower than the guy ahead of us. In both cases, there were accepted offers prior to us. In the one case, the buyer asked for an extension. We literally just jumped in and bought it. Because we came in with an unconditional offer. It was a no-brainer for the seller to accept it, because he knew it's a done deal, whereas the other guy's asking for an extension because he doesn't have his stuff all lined up. He's not ready to go. He's not educated enough. He's not prepared enough. So we got it $25,000 lower because we were ready. The property we purchased 2 days ago, the buyer collapsed his deal because he could not get financing approval. We came in, got it for $70,000 plus lower because we did not have any conditions on the contract. And this is where and how you find a good opportunity. There's a lot of elements to it. There's a lot of risk to it. But as you become educated, your fear starts disappearing, because well, if the hot water tank is gonna leak, it's not a big deal. It's only $1,200. If the furnace will go, it's not a big deal. It's only $3,500. And as you're educated, you look at these things and you don't need a home inspector to tell you that there's a leaking faucet. It's not gonna make any difference in the opportunity. And lastly, when you look at purchases like that, don't start fiddling around because of $2,000, $3,000. Ask yourself the question, is $2,000, $3,000 more or less going to make this a bad investment? And that's the most important thing. Don't put your own emotions into the way, because your emotions can be all over the place. Put your logic and your education into it, not your emotion. As an investor, it's not emotional, it's logical. As a buyer, when you buy your personal property, it is very emotional. And that's a whole different game. And today we're talking about investors. So here you have it, Lisa.
That's very good. I was just thinking about that whole emotional component and about how many hot water tanks we argue about these days. So I get that it's all about the dollars and cents for the investor, or should be. It has to be. That has to be the perspective. And the other thing I got out of what you just said too is you're talking bigger numbers. You're walking in and making an unconditional offer on a $900,000 place. Not everybody can do that. However, you also have, it's not just you. You have four other members of your four other brothers. So there's five of you and so that's an opportunity for some people too. They could get a partner or get a couple of partners and get into your first place, and then move on from there. So there's always a way around it if you're willing to be a little bit creative, I think.
Yes, and I think I was talking a lot about we, but I think ultimately all the credits go to my brothers, and the team we have is incredible, because without each other we could never ever do that. Never ever. So I think it is very, very important to have a partnership if there's a possibility. In many cases, there's fathers that have money, but they don't have the time or the energy, or they don't want to deal with it. And there could be an opportunity for a son to come in and support the father, and the father could support the son in those ways, or brothers, or good friends, or whatever it might be. It is a very good thing to build a little team of trusted sphere that you can invest in together.
And that's exactly what you have with your brothers. Every one of you brings a different skill set to the table.
Exactly.
Yeah.
Exactly. And it's great to have each other, because I'm the kind of guy that likes to close within the hour, unconditional. And then I've got my brother that's more of a C personality. He's more of the analytical guy. He does the numbers, he does the financing, and he's the one that kind of puts the brakes on me. But it's so important to have each other, because he looks at it from one perspective and I look at it from another. And the great thing is we balance each other out. We truly balance each other out. And it's always funny to see how we can sometimes push each other over the fence. And it's good, because if it wouldn't be for my brother Victor, we would have maybe been already bankrupt. And I'm saying this with a little bit of a joke, but the reality is, a lot of the financial success is not because I found the deals, it's because he managed the financial part really good. So don't forget about that.
Sounds a little bit like you're in my relationship, Alex, some days. So now tell everybody, what is the next step? If they want to get involved and get started with this, what's their next step? What can they do? Can they come in and meet with you and talk about it and get started on an auto search, and you can kind of guide them through the process? Yes?
Yeah, I think the first thing is to sit down and talk and brainstorm, because every situation is different. Everybody has a different financial situation or a life situation. I mean, there's guys that don't have a clue on how to do renovations, for example. So they may have to look at a different kind of investment. So there's so many different aspects, and it's important to build a little bit of a custom portfolio or search an idea of that person, to understand, okay, this is the kind of investment he needs, or these are the people they're working with, and then kind of work it from there. That's probably the best recommendation, because you can't really sit down and say, okay, here are the properties. I think it comes down to, okay, what is the guy doing for a living? What's his financial situation? Maybe he doesn't have as much as money, but he can do a lot of work himself, or it's vice versa. So it kind of comes down to sitting down, brainstorming, and building a roadmap. And I think the biggest important thing is, I talked about a lot of great numbers, but don't forget there's been projects where we didn't make a cent. And that is part of doing business. Don't always expect to have big numbers and big returns. There's also losses. There's also a lot of waste of time. And ultimately it comes down to an expectation, not thinking that you'll make a lot of money right away, but it's really a snowball effect that'll take some time to build up, and ultimately you will reward from it, because the Canadian real estate has been one of the greatest opportunities for immigrants like myself or other immigrants. Like, the opportunity is so great that sometimes many don't see it for whatever reason. However, as an immigrant, you come in, you don't know the language, you don't have a good job, you work in construction, you don't have no choice. But you can work with your hands sometimes, and the opportunity that the real estate market in Canada has provided is substantial. I think my father has tripled his net worth in the last 15 years.
Wow. That's excellent. That's excellent. So it's all really it's about starting the education process, sitting down and almost being a little bit like a financial planner when you're analyzing things like your how risk averse you are. And like you say, Alex, you know, you're pretty risk averse, but then your brother isn't. And yeah, going through that with people and then getting, you know, the best time to start is now. You started at 17 and now here you are. It's awesome.
Yeah.
Yeah.
Thank you, Canada.
So does anyone have any other questions for Alex before we tie it up, or anything else more, Alex, that you'd like to say that you might think would help somebody with their first investment?
No, I think I said enough. Yeah, it really comes down to just building a roadmap. I think that's important. Building a roadmap, understanding what needs to be done, and then taking small steps.
Yeah.
You know, it can start with your basement suite. It can start by putting a suite in your house. That's where it can start.
Mm-hmm. Yeah. Yeah, for sure. For sure. Okay, well, that's excellent. If nobody has any other questions, we're coming up here. Yeah, we're about 45 minutes. So we'll wrap this up and I don't see any other questions. So thank you, Alex. Really appreciate your time today and for sharing everything with us about what your investment journey has looked like.
No problem. No problem. Thank you.
Anyone want to call Alex? Just call our office, 250-549-7258, or contact him at alex@saltfowler.com, or his cell phone number, which is
250-307-8858.
Those smartphones have made me stupid. I don't remember anyone's phone numbers anymore. Okay, thanks everybody. Have a great day.
Okay, thanks. Bye-bye.